What's up, Gould Miners? In today's episode, I have the privilege of sitting down with Mike Stohler, a 25-year real estate investing veteran who has gone from single-family investing to multifamily investing and now into hotels, not just domestically, but internationally. And we go deep into all of that in this podcast. Early on in the episode, we talk about Mike's recent ventures outside of the U.S., international hotel investing, and what he's doing to drive business to those hotels overseas. We also go into Mike's early days and how he got started with single family investing and some of the failures that he encountered over those first 10 years of his real estate investing journey before he really kicked things off in 2010 to 2012. So whether you're a seasoned investing pro or you're just getting started in your real estate investing journey, there really is something in this episode for everyone. This is one of the better podcasts. Mike has a lot of knowledge. He's a straight shooter and he is a wealth of knowledge. So without further ado, everyone, Mike Stohler. Mike, welcome to the Gould Mine.
Sure, it's a pleasure. You know, it's finally good to be able to connect.
Absolutely. I knew you were in Barcelona there for a hot minute. Yeah, we were trying to get you on the show.
Yeah. You sent me the link, and I was like, well, okay, I could respond, but it's 2 a.m. his time. I was over there for a couple of weeks, finalizing some boutique hotel deals and trying to make the plunge to go international. We're having a good time.
I really want to dive into that, and maybe we would just start there. You know, and I'm sure that we'll go back and kind of revisit the story that's gotten you to this point. But you're now focused a lot on hotel deals, and it sounds like you're exploring internationally. What was the impetus for you deciding like, hey, like the U.S. isn't enough. Like I want to go overseas. Like what drew you to international investing?
Yeah, that's a great question. The inflation is really hitting hard with it, as far as the U.S. Labor is a lot harder in the U.S. The cost of labor, it's a bunch of factors. I'm getting ready to build this big one in the U.S., but my God, the labor cost, the cost of lumber, just everything is so expensive in the United States right now. And it's like they're just not getting it. They just keep raising interest rates thinking that we're going to stop doing something. So I've looked internationally, and what you can do internationally is get older estates that are out in the countries where people retire. You think of going up to Sedona, Arizona, or these different vacation spots.
Yeah.
But because the euro is a little more stable, cost of living is a lot cheaper because they do a lot of subsidizing over there. And I can get these 600-700-year-old places that people think of as like destination type places. I want to go to my wedding in Spain and an 800-year-old castle or this villa that you get to rent the whole place. And it's on 30 acres. And it's just one of those Cinderella type experiences that people want. A lot of corporate events are being held in these type of places, but you can get this real estate for really, really inexpensive. And then instead of having 20 people or 30 people running my hotel, I have a caretaker and like a husband and wife that does caretaking, the cleaning of the rooms, and then the maintenance. So it's a lot cheaper. And then, we're looking at Portugal, we're looking at Italy, but you don't want to be in the big cities. You just go into these countrysides, where even people in Barcelona want to spend their weekends up in the mountains. So it's the cost of living, the taxes, everything's a little less expensive over there. And plus, every time I go to Europe now, it's a tax deducted vacation, which is really nice.
Hey, absolutely. I got business out there, baby. Yeah,
I got business out there. Oh, it's gonna.
Love it, man. It reminds me. So I came up in the residential space, as you may or may not recall. And so I did a lot of YouTube videos, or still do a lot of YouTube videos, but I would always find, wherever I'd go, I'd find an agent locally in the metro or whatever that I was visiting, and it'd be like, hey, like, let's do a video together and, you know, showcase some of the real estate here. And that's how I took it to my CPA, and I was like, hey, like, I was over there doing business, and he signed off on it. And yeah, so there's always like 50 ways of, yeah, exactly. Of, you know, you just you think outside the box. So that's awesome, Mike. That begs a question though. I'm putting my investor hat on right now, and I'm like, all right, well, that sounds great, and cost of living's lower, but like, what are the returns like?
Yeah, this is going to be patient capital. So number one, we're getting into these boutiques. Let's say it's 10 to 12 rooms for $1 million. I'm going to raise money. We're just going to pay it off, you know, plus a couple $100,000 for renovations. And then we have to spend money on the backlinks, the website, you know, getting the world to know that we're there. We're going to have a couple influencers come in and basically say, this is the place. How can we get a backlink through the Robb Report, the wedding, all these different publications? So that's going to cost some money. And then we're thinking, well, the fact that we don't have any debt, we're going to spend $50,000 to $100,000 on the PR side to get everyone to know that this is the place to go if you have a destination. We're also going to open it up to daily rate, but the first return is going to be probably in a year or so. And then the actual returns on investment, you know, based on an IRR it's going to be based on how well we do the PR side. And then the daily rate for the people coming up, let's say from Barcelona or you know, somewhere else in Spain. One of them is very close to France, you know, right along the main highway just south of France. So the actual return on the pro forma, because we don't have any actuals, I can't say, well, this is what the comp set is doing in this area, like you can in the United States.
Yeah.
You know, what other boutique hotel built in 1610 can we do a comp set on? You know, it's, but here's the thing is each room's going to be $300 to $400 a night, $10,000 or more to rent out the whole place. We're looking at getting a local PR firm to manage it and do that side of it. So we're looking at very, very conservatively, like pref returns of 15% or so or more. I'm hoping more because there won't be any debt, but I'm going to be just really conservative after the first year, what we can do. And then it's just a build up from there. And we could see some pretty extraordinary returns on such a small property because we don't have any debt. But it's building up that. I can't say whether it's going to be year after year one or after year two. It's building up the point to where, hey, world, this is the most extraordinary place in northern Spain that you can go to for this destination. And we also have like these shamans and these yogis that are interested. Some of them are very interested right now in holding a retreat. And these will be, it's crazy, you know, $3,000 a person to go and eat once a day and do yogi stuff and dance around. And it's like, okay, you know, for $3,000, you can dance around the property all you want and do all these things. But it's, you know, sing Kumbaya. I don't care as long as you pay me $3,000 a person for 4 days. But that's one of the big things that is really huge right now are these different shamans coming in, and it's good for them because they'll come in for free as long as they can book the whole place and it looks good on their resume. You know, come to this yogi retreat in northern Spain, and they just blast it off to their people. And so those are the things we're looking at. But to give you this is a long story short, to give you a pinpoint on the returns, I know it's going to be big, but it's just the performance is just so hard to do it after year one on what we could do. It's just a perspective and the romanticize of the part that, hey, you own a piece of a boutique hotel in northern Spain that you get to go visit.
Yep.
And say that you own it, but we're looking at 15-20%, very, very conservative. I think it's going to be more than that since we don't have any debt.
I could totally see that. And what you're talking about too is looking at the hotel as more than just a place, like heads in beds, place to stay kind of thing. You're really looking at it from a like business standpoint, an event center that happens to have beds that you can sleep in, and rooms that you can sleep in, which is interesting, you know, and I think that there's a lot of boutique hotels. There's some boutique hotels in the States that do that. So I could see that business model working out really well. I could also see there being a little bit of a ramp up period. So what you're saying, I think is totally true. Like you probably won't see returns for like the first year. That begs the question though, like, since it's more than just like the hotel business, it's also an events business, right? Where you're trying to draw on people to do, you know, sounds like weddings and corporate events and retreats and all that good stuff. So is it you that's running the business side of that too, Mike? Or do you have someone helping you, like an operator? It's you.
Yeah. Great question. No, it's not me. Okay. I do that over here in the States, but it's no, it is not. So we already have a team in place for Europe. We have operations people. We have someone that we're interviewing for the Northeast one to actually run it. They specialize in what's called the Masía, which is this type of boutique. Masía is Spanish for rural house or estate. And with their contacts, and they're basically an event coordinator person that we're hiring to run a boutique hotel. So we're looking at it as that type of a business. We'll still be on Booking and TripAdvisor and things like that for the daily bookings. And we'll open that up when we don't have someone renting out the entire place. So we are looking at it in that business side because we're hiring someone that does event coordinations in Spain. So that's how we're running. We have the CPs, we have the attorneys over there. So we already have a team. And unfortunately, I'll have to go over there once a quarter just to check things out and stay in the place. And that'll be a horrible experience. Drink some Rioja and make sure everything. I know it's horrible, but the good thing is the people that invest with us at a certain level will have access to the property a couple times a year. You know, so they can also have a tax deductible vacation in Spain. That'll be nice.
That's awesome. So someone's probably listening to this right now and saying like, man, yeah, sure is nice to be able to invest overseas. And they're not even close to that, Mike. So obviously this is how long into your investing career are we now?
Oh boy. I started out with a single family house. I call it the PG days, pre-Google days. So it's been a while.
Oh, wow.
I invested in my first house, I think in 1998, had 8 homes and failed miserably because I didn't have podcasts. I didn't have Google. I couldn't type in a search engine on how to be a landlord. Buying the properties was easy, but now what? You know, so I failed miserably, became an airline pilot. I got really back into it big time after the last recession. You know, that's when I made all the money, is back in 2010 to 2012 is when I ramped back up. And when the commercial guys, when their notes came due and the banks weren't lending, you know, because of the crash. So I just came in with cash and that's when I really ramped back up. So about, what's that now? 12 years ago.
Yep. Got it. So you've had over 2 decades worth of ramp up, and it sounds like the last 12 years have been the time where you've made the most amount of moves. So walk us through that journey. And actually, like, what I really love to know is what you just touched on right now is like that same thing is about to happen. It's like already started to happen, where you've got a lot of floating rates. You've got a lot of short-term 5-year loans in the commercial sector that are coming due. What lessons did you learn the first time that either like that you will deploy this time and or like you would recommend to someone like myself, for example, to do this time? How did best position yourself for those sorts of opportunities?
Yeah, great question. Number one, right now, in the States, I would not recommend, unless you're developing, unless you have a really big project, kind of hold off on some financing right now, unless you have 40% LTV, 50%. You don't get anything for 20% right now. Even if you can, maybe even 30% down. For instance, in the Scottsdale project, it's going to be a $25 million project. I'm not going to do it unless I can get at least 50% money down so that I can hedge the lower payments. I don't have as much debt. And that's what you want to do during this time period is don't over leverage yourself during this time because interest rates are high. And then you look at the bank and say, okay, no prepay penalty, because when something does happen and it goes back down, I can then refinance without any cost. And that's the only way that I would finance now is if I had no prepay penalty and then I can refinance in 2 or 3 years. And then as far as what I did in 2011, 2012 is you have a lot of floating rates. You have a lot of variables. You have a lot of in the commercial space, you have 5 and 7 year loans typically. And what happens is they over leverage. They paid a lot of money for this asset because they were speculating that the interest rates or the economy would just go up, from 5 years ago. And now you have banks that are like, you know what? It's kind of worth what you're saying, but we're no longer going to be in the hotel industry. We're not refinancing your loan. We're not doing anything. Or even multifamily. It's like, look, the cap rates are just too low and interest rates are 6%. Your cap rate's at 4%. Yeah, we may not want to do that right now. So I go in and do what I did is a lot of seller financing for those type of guys. I just kind of take over their debt, give the seller a little bit of money, and then just do a lease to own or seller financing. That's how I made a lot of my money back in the day. Was I'd get these people that are in debt and I say, look, you're either going to lose this place. You can't refinance it. I'll come in with cash, with investors that have cash, and give you a little bit of money and then just take it over. And then I'm able to write it out because I have cash and I have investors that are behind me that we can kind of write it out and then refinance and make the money. But it's looking for that seller, not even a seller, just the owner that's like, oh crap, I'm stuck.
Mm-hmm. How did you do that back in 2010?
Back in 2010, 2012, what I did was I saw properties that were on the market because they're like I saw the prices starting to come down and I could see that the seller was a little bit starting to panic a little bit. And then I just talked to the seller. I say, hey, what's going on? And he goes, look, this is 100% occupied property, but the bank won't refinance it because it's not worth what I owe. And then I'd say, okay, what's the delta? And I'd look at it and I'd talk to the bank and he didn't, the people didn't manage it properly. They're only maybe $150,000 difference. But I'd go in and work with the bank or work with the seller and say, look, I'll pay the delta on the $150,000 or the $200,000. Sometimes it was $300,000 of what it's worth to bring it up. Because, let's say it's $1 million property. The bank's only going to refinance it for $600,000. He or she has to come up with $400,000, the delta, because it's now only worth $600,000. I'd come in and just pay that difference, keep the same loan, and just go from there. Sometimes I did a complete seller financing for 3 years just to catch the person up. And then at the end of the 3 years, I just then refinanced. But then that person, the owner, is completely out of it. I'm paying his payment. I'm paying him. He's paying the bank. I gave him the delta. And then in 3 years, then in like in 2015, when everything was cool, I would refinance it. So I did a lot of that type of a thing especially when the banks were really pulling back. I did a lot of seller financing.
What was the messaging like? Because I would imagine that going to a seller or an owner and being like, hey man, you're screwed. Want to sell your place to me? Like, I don't imagine that that's necessarily going to go over well. So how do you massage that conversation?
Yeah, it's a good question. You have to, I let them talk. So what's your situation? And they spend an hour, woe is me, and screw the banks and I let them do their thing. And then if it was perfect situation, it's like, and then I would just say, looks like you're probably going to get foreclosed on. What does that do with the credit? I'm a stupid young investor. What does that mean for your credit? I just kind of fake it. Yeah, it's going to screw me. I'm not going to be able to get another asset for another 7 years. It's like, well, what if I could help you out there? Your credit's going to be fine. And at some point, you're just going to have to take a loss on this one place, because your alternative is go through 7 years of bad luck. You won't be able to buy another asset. Or I can just come in and save you. Your credit's going to be fine. I'm just going to act as you and pay your bank mortgage. And I'll give you $150,000 for your trouble, but it's going to be, a 3 or 5 year note. And now we both win. I get an asset. You get your credit. As soon as it turns around, you get to buy something new. And we help each other both out. And then you just shut up and let them speak first, because now their wheels are spinning.
Mm-hmm.
And that's how you play it. You have to convince them that it's their idea, that it's the best thing that they can do to save their credit, to save face, and just say, look, you're going to. There's no good outcome. What's the better of the two outcomes for this property? And you have to convince them you're the better outcome.
Yeah. I hope everyone is taking notes. Listening right now, you're like, hey, this is good dialogue. And a couple things that I observed there. Number one, what's your situation? You get them talking, because I think a lot of people that don't understand sales, which is a lot of people, they do all the talking. Then the other person doesn't actually. So the only way that you can build rapport is actually by listening. So I observed that is okay, you what's your situation? You let them word vomit for as long as they need to. And then you ask them the question that plants the seed of oh, what's that going to do to your credit? Right. Oh, okay. Well, then they're like, oh, it's going to decimate it, blah, 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 blah. Well, what if I could help you? Right. So you take them through the whole sales pitch.
You do.
Yeah. And I
maybe said 5 words during the whole conversation. Mm-hmm. So that's the whole thing, people, is you got to learn how to shut up. They'll tell you exactly what they want and what they need if you just pay attention and listen. And you have to be able to understand what it is and then say, oh, if I'm hearing you correctly, this is what you need. This is what the outcome, your unique thing that needs to happen. Is that correct? And then shut up again. And then they'll confirm that they want you to help them.
Mm-hmm. Before we jump topics, I am curious, where were you sourcing this data of sellers? So it sounds like you said you were watching prices drop. So you were probably looking at active listings, but I imagine that isn't the only type or the only criteria that you had. So where were you sourcing these potential deals?
So the best thing you could ever do as investor is networking. Get to know the bankers, get to know the title agents, get to know where do you find public records. And if a lot of times I went with, and also a lot of brokers. So if for instance, brokers know that you have money or you have the ability to find money, they'll give you off market deals. So it's like, hey, Mike, I'm talking to this person, or you can get to know a lot of bankers through networking events. I've actually had bankers say, "Hey, Mike, I've got this guy. Can't introduce you, can't do anything like that, but you can maybe stop by the property." And then title agents have the ability to come up with different lists of this person got a loan. All these people got a loan on these apartment complexes 5 years ago.
Mm-hmm. Mm-hmm.
And this is what they owe. And then I can have the broker go in and say, "Hey, okay, give me a list of what all these properties are worth, based on how much debt they have that the title agent gave me." Then I can quickly see that, okay, these people are upside down. And then I just cold call. I find out their information, find out who the owner is through the title agency, because they can get the list.
Right.
And then I just call them, write them emails, and I just bug the hell out of them, and say, "Hey, it's me again." And then, once in a while you get the thing. It's like, look, you have to write the letter or the email properly. But those are the title agency. A lot of people don't realize that those title agents have a lot of ability, a lot of lists, a lot of contacts. They can give you anything you want as far as all the different type of properties, when they were bought, what the mortgage was, who the mortgage was through, because they did all the title work.
Mm-hmm.
So that really, really helped me.
Gotcha. And that, so in 2010 to 2012, the majority of the deals that you were sourcing then were multifamily. Sounds like
I was my entire history was single family and multifamily. I've had managed and owned 1,500 keys. Well, that's hotel doors. I mean, keys now.
I knew.
Yeah. Swipe keys. Yeah. Now I'm into the swipe. So I was a huge multifamily, even back in the day, 4-plexes, 2-plexes, 7-plexes, 8-plexes, 50 units, 100 units. And it wasn't until over here in Arizona that the cap rates were really, really started to get compressed.
Yeah.
And I was like going, and I had people just randomly, just doing what I do, randomly call me and give me insane money on my multifamily complexes. And I'm like going, now what do I do? What am I going to 1031 into? I'm going to be someone else's fool. They bought it an 8 cap. I'm buying it a 3.5 or 4 cap.
Yeah.
So that's why I made the jump into hotels. I don't like to speculate. I don't want to buy it 3.5, 4 cap, and my interest rate's a 6.5 cap. Some people still do it.
Yeah.
But I don't know. Maybe I'm too old for that type of stress.
I think that what a lot of people don't realize, a lot of investors don't realize, is how great the returns are on hotels. Cornell did a study over a 25-year period, from 89 to 2015, through 3 bear markets. The highest annualized returns amongst all commercial real estate asset classes is hotels.
Yep.
So hotels outperform office. Well, yeah, I mean, easy to do nowadays, but multifamily, retail, all that good stuff. Now, I'm not sure about self-storage. I don't know if they section that off into like industrial or like light industrial as a whole, right? If that's part of that, but it's something that a lot of people are unaware of.
Yeah, a lot of people don't realize that individuals and people like you and I can own hotels. They think that they're just these big REITs and big corporate things, and it's wild when people ask what I do and I say I own hotels. It's kind of like you get that deer in the headlight look. But yeah, you're right. The biggest difference between the hotels and multifamily is, if you think of my ADR, my rate as a rent, like for your multifamily people, it's like a gas station. I get to change my rate 4 times a day. I'm not stuck with a 12-month lease or a 6-month lease. I can go from 80 to 100 and 120 back down to 70. It floats. So I get to think of a 100-unit multifamily at $1,000 a month. It's X amount of dollars. My 100-unit hotel, I get $100 every day. Mm-hmm. And then spring training, it's $250 every day. Or, when the Waste Management, when the Super Bowl was here, it was $300 a day, times 100. And then it compounds. So the gross revenues are just so much higher. Yes, we have more expenses, mm-hmm. but just the gross revenue of the two is just so much higher. And that's how you can get, double-digit returns easily in hotels instead of 3 or 4 or 5% multifamily right now. But everyone, don't go out and just buy a hotel. They're completely different. It's a business. It's not real estate. Okay. It's a business that sits on real estate. And I have some hotels that real estate is really, really appreciating. And it doesn't matter what's on top of it. People want to buy it just because of the real estate it sits on. But you have to learn how to do hotels. Don't just jump into them. They're a beast of a business.
Yeah, I could not agree more. And I think that, coming from residential and then getting into hotels myself, the good thing for me was that I had transitioned from just a realtor to like actually owning and operating a full-fledged like real estate team that operated much like a business. And so I had I knew how to read a P&L, I did like the basics, but even still, there's so many layers to the hotel business. So that begs the question then, Mike, when you bought your first hotel, mm-hmm. what lessons did you learn the hard way?
Oh, good question. The due diligence, I was used to doing the due diligence the multifamily way and not really looking at the due diligence as the business side. Mm-hmm. And one of the big things is what I learned is a lot of the hotels are, some of them that are individually owned are owned by the families. Dad's the GM, the wife is the head of housekeeping, you have the kid at the front desk. So they're, especially when Indians own it, the Patels and mm-hmm. people from India, the whole family gets involved. So the salaries and the payroll is very, very skewed because they only take so much just to live and put it all back. And I realized that they were going to these little grocery stores. They were doing things, which is all fine, but it wasn't a true P&L based on me coming in and hiring everyone to run it and having a full payroll. So that was one of the biggest things. It's like, okay, keep that in the brain. If it's a family run, are they making their breakfast? Are they buying it from Cisco? How are they going to Costco? What are they doing? And then because they're so maybe stingy, they're doing just the minimums, getting by with a lot of things. And it's not really, they're running it as they would a small business, not a full-size business. So that was the biggest thing. And then thing I learned is just handling people. When all of a sudden you have 15 people, employees, it's just learning that side of it. From multifamily, you may have a maintenance person, a salesperson. Now I have 15, 20 people. Just managing expectations and managing that type of payroll, just the personalities. That was another big thing. And then, my God, just looking at all the different vendors, what's necessary, and coming in and the other biggest thing is when you come in and buy a franchise, let's say a Choice Hotel, they're going to come in and say, we have what's called a PIP. Mm-hmm. And they're going to say, hey, you have to do these 3 pages worth of stuff in order to buy this. Well, I didn't know any better. I'm like going, holy crap. Okay. So you do it. Well, I didn't realize that most of that's fluff. That's like going, we'll see if Mike's an idiot and actually do this stuff. And I was an idiot, and I was not going to be an idiot again. For instance, the hotels that I've bought since then, you get to 3 and 4 pages, I whittle it down to 1. Mm-hmm. And I make them pay me. How bad do you want me? Especially I'll go in and maybe change it from a Choice to a Wyndham or things like that. And then I'm like going, hey, Wyndham, how much you give me $150,000 to go with you?
Uh-huh.
And they do it.
Yep.
Yeah. So those are kind of the biggest lessons. Is PIP is a big thing.
Yeah, that is a big one. And if someone, because there's a lot of people I'm sure that are listening that are like, hey, I'd like to get into hotels, and you're like, hey, don't do it unless you know what you're doing. So what would your advice be to someone who wants to get into hotels?
It's like every asset class, people, it's get a mentor, get a business coach. Mm-hmm. You don't go from single family to even multifamily. I'm not talking 4-plexes, 6-plex. You don't just go out and buy a 50 unit unless you know what you're doing. I ended up partnering with someone that had 25 years experience in the hospitality industry, and that's what made us grow.
Yeah. Now
I can look at assets. Now I can manage the investor side and let this person go out and say, this is how you run it. He deals with the day-to-day.
Mm-hmm.
So, or invest in someone like me that does syndications and then learn how to do it. I've had some investors say, Mike, I want to invest, but I want you to teach me how to do it. And then we come up with an agreement, how to teach them, things like that. Everyone wants me to start doing like some seminars and things like that, or like workshops, because there's no one who does hotel workshops. So people have been pestering me to do some workshops, so learn, get business coaches, get with people like me that have done it, but don't just go out and buy it. And it'd be the same with even multifamily. Learn how to do it first.
And this would be a great time to mention that all of Mike's contact information is going to be in the description box down below. So if you are wondering how to get in touch with him, either to learn more about how to invest with him as an LP on the syndication side, or want to learn more about mentorship or any of the above, right? We'll get your contact information down there in the description below. So that's awesome. That's awesome, Mike. Well, let's switch gears here a little bit, because we spent a lot of time on hotels, and what I want to understand is like obviously you had what it sounds like is you had a crash and burn moment before the .com bust, and then you spent the next 8 years or so rebuilding, and then what were the lessons that you learned the first time that allowed you to succeed the second time around?
Yeah, great question. What I did is I learned buying properties is easy. Anyone can go out and buy a property. I ended up finding a mentor, finding a coach that taught me. That's the missing piece, everyone. Anyone could go out, go to seller financing, buy a house, fix it up. But to be a landlord, it's, what's a notice? What are the laws? What's the tenant landlord regulations, especially, in the different cities where maybe they're pro tenant, not pro landlord, or vice versa. Learn, there's a reason why you're listening to this podcast, because you've made the first step. You're learning. Find a mentor. Don't go to seminar land, because they're not going. I count maybe something. I count on maybe 2 people that actually do it and then do the seminars. One of my mentors, his name's John Burley. He actually owns a couple thousand homes, and he does seminars 4 times a year. He doesn't do seminars in every single city 50 times a day. And the last time he bought something was in 1999 or something like that. He actually does it. So find out that type of seminars is good because they're actually doing it, and you actually get to talk with the person and the expert through his programs. He's still a very good friend of mine to this day. But that was the biggest thing is I sat down and it's like, okay, what piece am I missing? I don't know how to be the landlord part. I learned how to build a team. That was the most important thing. It's those growing pains that sit there and say, okay, find your unique ability. What is my unique ability? It's not bookkeeping. It's not, managing people, because I started managing people, then I start hating people, and then it's like you're doing what? You flushed what down the drain? And it's like, what are you, you're yelling at the person down the bathtub drain. It's like going like, what the hell's wrong with people? So I gave up and just concentrated on finding assets. That's what I'm good at. I'm good at finding investors. Delegate, find a team, find a mentor. You're either going to spend your money the hard way and possibly losing money by learning, spending money and losing, or you might as well just spend the money the right way so that you can succeed quicker. Either way, you're going to spend money. So whether or not you lose or you gain it.
I could not agree more, and I can share from personal experience here. When I started in real estate, I had all the ambition, all the drive in the world, right? But ambition and drive and tenacity, work ethic, it's not enough, especially when you're getting into a new business, a new venture, like you need that guidance. And so the hard part is for a lot of people to like cast their ego aside. The money is also a part of it too. It's ego and money. But the second I got a coach, my business exploded in real estate. Absolutely. And so I took that same experience and I applied it to hotels. And so when I got into hotels, the first thing I did was try to look for a mentor and find someone to coach me. And what's crazy is that, and I really feel like this is the future of education, because I think people are finally starting to realize like what a joke university is, and like how impractical it really is to like spend 4 years at an institution, like get a degree and then go out and do nothing like with it, versus the coach is like, okay, maybe a third, half of what 1 year's tuition would be at like one of these institutions. And then you've set yourself up for massive success because you have paid to learn all of their mistakes.
Absolutely.
And it's something that I think I could not agree with you more on. And it sounds like you took that lesson, you applied it, you found your mentor, and then your mentor helped you grow and helped you understand, okay, like the business / landlord side of it. At what point did you feel confident enough to be like, okay, like I think I've got this, and like I'm gonna go like do this on my own again?
Yeah, you never really get that. Even now, I don't get that. There's always self-doubt. But at one point, I'm also ex-military. So at some point, you just got to make the leap. The hardest part for everybody, I've met people when I've spoken at seminars across the country, you see the same people, seminar junkies. And I'm like, have you done your first deal? No, just one more seminar. I'm almost there. Need a little more coaching. The first part is just like, just do it. Jump in and do it. So I was not comfortable when I got back into it because, look, I lost everything. I was newly married. I had to move in with my in-laws, and we took a large hit. And one thing that makes me a better mentor or a better investor is I'm one of those people that instead of lying to everyone, I'm like, I failed miserably. Most people are just like, oh, I made my first $1 million in 5 months and everything was hunky-dory and it's just like a HGTV episode. It was just perfect. Bull crap. This is not easy, everyone, and you're going to fail, but what do you do? I've never learned when I've succeeded. I've learned when I failed. And so you just have to make that I knew that real estate was it. I knew that if I stayed in a cubicle one more day, I was going to go postal. And so it's just, I went, bam. It's like, I'm getting back into it. Here we go. Let's start small. But then because my mentor had owned a bunch of properties and here's the forms, here's the applications, here's how you do it, here's how to be a landlord. I was successful because I had the business side of it. And then it was another one, then another one. Then you kind of build the confidence up. And then when you get an apartment complex, then you get scared again. It's kind of like, okay, am I ready for a 20 unit complex? It's like going, of course you are. You have 10 single families.
Yeah.
Now you have everyone in one spot. Now I'm not traveling all over the place. So there's always that kind of self-doubt. When I buy another asset, especially now when you have investors, it's like, okay, you kind of overanalyze and it's like, do I want to do this? Is it safe? Is it the type of hotel I want? So you're always going to have that. You look at every rock star, every golfer, they're always nervous on the first tee. Mm-hmm. They've hit millions of golf shots, but they're still nervous. So you're still nervous, but you now have the confidence knowing that you can succeed.
Yeah, that's one of my coaches calls it borrowed belief. It's like, hey, like a great mentor, a great leader can inspire others through allowing them to borrow their belief until they themselves can feel confident enough to go out there and do it. But once you get there, you have to continually draw on that. It's like, it's not enough to do it the first time. It's like, no, there's still doubt every single time you go out there. So I appreciate you, sharing that, because anyone back at home who's listening and whether you're a seasoned investor or just getting started, just know that it doesn't get easier from there's always going to be that. Even Kobe got nervous, right? Like you said, right? So there's always going to be those thoughts, but the difference between the people that are the seminar junkies, as you call them, right, Mike, and the people that are like Mike, are those that just can cast those fears aside and just do it.
Yeah, it becomes an excitement. Instead of an anxiety, it becomes, okay, I'm nervous, but man, all right, I have another asset on my belt. Everything, I've done my due diligence. I've done all my checklists. There's nothing else I can do except pull the trigger. And you have to have faith in your team and your checklist and your due diligence. And something else I can tell people is, don't get emotional with your asset. Mm-hmm. Make sure it checks every box. If it doesn't check every box, don't do it. There'll be other assets. Don't get, it's like, oh my God, I always wanted a castle in Spain. Well, I did, but it had all the checkbox. There are other castles in Europe. So you just, and it's like everything else. It's, hotels, and make sure you check all the boxes. So
you hit on it right now, and you talked about the team, right? And you mentioned it before. So what does your team look like right now, and how is that structured? Just genuinely curious.
Mm-hmm. I always have offsite bookkeepers that are not part of my team. That's just part of my separation of power. Mm-hmm. When you have investors, I don't want them to say, well, the bookkeeper works for you, they're going to do whatever you want. So I have an offsite bookkeeper. I have area managers. I have operations people. I have people that concentrate on sales and marketing. I have someone that concentrates on what we call engineering in the hotel world. It's basically the maintenance, but they're called engineering. And then, each hotel has its own general manager.
Mm-hmm.
And that's about it. Sales and marketing, operations, the mechanical, the engineering part,
Mm-hmm.
the bookkeepers. And then, the actual CPA is make sure that, man, I learned the hard way. Make sure your CPA knows real estate. Okay. Don't get just a regular CPA. After 10 years in the business, the guy did an audit on my taxes. It's like going, you're not deducting as a full-time real estate guy. I don't know. You're, as a real estate professional. He goes, you're a real estate professional, aren't you? And I'm like, yeah. And he goes, your last CPA who doesn't know anything about real estate, I never took that. I'm like going, oh my God. So just make sure that CPA, I pay a lot for my CPA, but they do a lot. And they know commercial real estate. Don't get your H&R Block guy or whoever, just your regular CPA that does normal people's taxes, because you're not a normal person at some point in your real estate career.
Wow. I mean, the dollar figure, I hope you didn't calculate the dollar figure on that, but I in my head is like, well, that's, holy cow. Well, yeah, that's, actually it's slightly similar story. I had a CPA, just a cookie cutter kind of guy for my first few years in the business. And then I had a monster year, like my first monster year in 2017. And a couple of years later, I got a new CPA who was a real estate guy, like understood real estate backwards and forwards. He worked, it was some commercial real estate accounting firm. And he looked at my previous years and he's like, dude, you overpaid by I'm not going to say the number, but he gave me the number, and I was so mad. And I was livid, and I was like, I should sue that old. And I was like, forget it. But yeah, no, it really does make a difference. And it's people that say, oh, I'm going to do my own taxes, and I'm like, oh my God, are so dumb. Yeah. So dumb, because you're saving, $1,000, maybe $1,500, but losing tens
of thousands. It's the same person that said, Mike, have you ever considered, I'm seeing that you're not doing cost segregations. And I'm like, what does that mean?
Oh, no.
And this is back in the day, people. This is not 2 years ago.
Yeah.
This is when I first started. And he was like going, oh, okay. Do cost segregation. Wow. So it's everyone there, a lot of you probably just starting out or now Googling cost segregation, because just like me back in the day, it's like, you don't realize when you get big enough, all these different things that you can do that are within the tax code to accelerate depreciation and just do all these different things to help your business. And cost segregation has become a huge one. To give you an idea, back in the day, I bought a $5 million hotel. My first year depreciation with cost segregation was $1.2 million. And the investors were extremely happy on their K1s for that. But cost segregation can save you a lot of money up front.
Yeah, absolutely. And that's definitely one of the powers of investing in, especially assets like, larger commercial assets like hotels is, hotels too, because you got the case goods, you've got other stuff.
Everything.
Just
every lamp, every stapler, every desk, every piece of soap. Not soaps or anything like that, but every case good, it has a depreciable time period.
Yeah. And it's, it can really start to add up. So, well, Mike, we're coming up towards the end of our time here. Just a couple other things I wanted to touch on real quick. So first one is, I really would like to know, because you're definitely someone that I think would have a great answer to this, is what is a contrarian point of view that you have about real estate investing that you stand by, but maybe most people don't necessarily agree with you?
Oh, what can I say about that? What I look at is nowadays, with especially the younger generations, they want that McDonald's quick fix. How can I flip something, make 10 grand, 20 grand? Mm-hmm. I don't look at it that way. Number one, once you get into an income, I don't want returns. I want a long term. I look at the great thing with multifamily and hotels is not the quick fix or the quick flip that is so popular today. Mm-hmm. I can own an entire asset class portfolio, and I can be 80, 85 years old and never have to retire. I just go to the board meeting or do this or that. So my outlook is that I am building patient capital, something that just appreciates over time. I don't look at 1 to 2 year flips that is so popular. I want a 10-year project. I look at, this $20, $25 million project. I'm not going to flip it in 3 years. I could to a REIT. But I want to know that I have a portfolio that gives me hundreds and hundreds of thousands of dollars a month, and it just sits there. And so that's my kind of contrarian is I like the patient capital where that's not popular right now.
What's the dialogue that you have with investors? Because, I think one of the main reasons, at least on a syndication level, that we talk about, 5-year exits or so is because the investors want their money back. What are the strategies that you use to kind of, what's the dialogue there that you use with the investors to get their buy-in to do, to think like that?
Yeah. Number one, I try to find investors that don't need a return. Most of my investors are sophisticated. They don't need a return. They don't need a monthly or quarterly return. And if they do, they want just put it back into the business. But what I do is I tell them, it's like, look, if you want a quick return, go find a fix and flip multifamily. Mm-hmm. What I'm going to do is give you 2.3 times your money or whatever it is down the line. That will happen, but it's going to be 7 to 10 years. But you'll be getting money, you'll be getting your returns, but we're not flipping. These are your retirement. Instead of putting it in their 401k, your IRA, putting it in stocks. And, with your stock market, you're going to keep it there for 10, 15 years, and just build up your stock portfolio. Now you're diversifying into a hotel that's going to give you better returns long run. It's an asset that depreciates or appreciates, but you get depreciation. How many of your stocks are going to give you a dividend, every quarter and appreciate like the real estate does? So I kind of do it as you've got the money, you're diversifying your stock portfolio or whatever into land, real estate, a hotel, but it's going to be that same type of, 7 to 10 year thing. And then some of them are like, I want longer, when you refi, because they don't want their money back. They want to keep it going. They want that long term. So it's just explaining to them up front that this is a business. I can't do this to a hotel in 3 years, or 5 years. It's not to say that some of them, we've sold in 5 years or so like that, but we have, because people just come in and say, hey, I want to give you this amount of money for it. And I'm like, yeah, okay, we'll do that. But, it's a good question. It's just explaining to people that this is a long-term hold, just like you would in the stock market. You buy stocks, you just keep it there until you retire. It's kind of like that instead of this quick real estate fix flip Airbnb, put lipstick on it and sell it in 3 years. I just tell them up front, I am a long-term hold GP.
Yeah. And as long as you're transparent and there are plenty of investors out there that would sign up for that. I know, like especially the ones that want to keep their money working for them. They don't really need that like return of capital. And by the way, like refinancing is also a very viable strategy, especially right now with the debt market. Like if you can find an opportunity right now, I know you said don't invest, and I think the message there was don't invest with super high leverage, which I would agree unless you're getting like a smoking deal. But if you can weather this storm, there's a good case to be made, 3 years down the line, being able to refinance into a much better rate and pull out likely the majority of the equity. And at that point, you can decide, well, do we want to hold on to this asset? Do we want to get rid of it? But at that point, why would you? If you've got a great rate and it's cash flowing and the investors have their money back, let's go find another deal to put it in, right? And just infinite returns on this one. So
yeah, that'll be like the Scottsdale one is, we're going to get an interest rate that I don't like, but I know that asset is going to appreciate so much and the interest rates will come down. And you're right. I'll just refinance it in a couple of years and either pay out the investor. There's other things that GPs can do if you want to go on that side is just cash out the investors and then you keep it yourself. Cash out some of the LPs and hold on to the LPs that want the long term. There's so many things you can do.
Right. 100%. Well, Mike, in traditional Gould Mine fashion, I'm going to leave us with your final Gould nugget.
Gould nugget.
Yes.
So all of you are into investments or want to be getting into investments. Don't go into this looking for money. Okay. Money will come. If you're patient enough. God's not making any more real estate. And you look at all the richest people in the world, a lot of them are in real estate. Find out your why. Why do you do this? Why are you wanting to do this? For me, it was I wanted to build a life that I didn't need a vacation from. And I can do that. I can be anywhere in the world and work anytime I want. And I don't have 2 weeks of vacation. It's something that I love what I'm doing, and I can do it whenever. I can be in an RV, I can be in Spain, I can be on a cruise, and be anywhere in the world and run my hotels. So find your why, but make sure that why is not money, because the money's, it'll come if you do it right.
It's fantastic advice. I appreciate that, Mike. Love it. Love it. So thank you for coming on the show. This was a lot of great. Now, I'm really glad that we got to spend some time there, especially on the international stuff and on the hotel side of things. Lots of great things for the people back at home to go out there and implement, whether they are seasoned or whether they're brand new. So, Mike, thanks for stopping by.
Thanks a lot. It's a pleasure.
All right, man.